Oscar is somebody that our marketing guy, Greg Lewis, calls a force of nature. He is very dynamic. He's a great presenter. We love listening to him just because he's very, very entertaining. And he always has some pretty good ideas about what's going on in the market. I understand that he both has power right now and he has internet. So those are two things that are going to be very, very helpful for him when he comes to do a presentation with us. So let's go ahead. Oscar, how are you doing right now?
Thank you for inviting me. Traders, if you waited for me at 3 p.m., my apologies. We had an outage in the whole neighborhood, and I just got back up and running. Again, I don't even actually have internet. I hope this makes it through the next hour. But what I wanted to do is present to you what I see as technical analysis that's very important today and tomorrow for the election, what we should be looking at, and what we should probably do if the election goes plus or minus, negative, positive, however you want to view that. So that's what I'd like to show you today. Jeff, thank you once again. Much appreciated. Love doing these MetaStock conferences with you. And thank you for my Omniacs out there. If you stuck around 2 hours to wait for me. But you know, sometimes the best things are worth waiting for. So, Jeff, how would I now remove this big screen? It looks like a big picture of me on my screen so I can show.
Well, sometimes that happens, and I just usually move it to a different monitor. Like, you could turn off your webcam too, but I don't think there's a huge reason to do that.
So I think we'll leave it on for now, unless unless I start getting throttled down by T-Mobile or something.
Yeah, we can hear you and we can see you fine. I don't know how to, and I can see your screen. I can see your notepad, but I don't know how to. Sometimes it does that to me, where it's just all you can see is your face, and I don't know how to fix it.
Okay, so I think we're set, and I will try to help all of us out to see what should happen with this election tomorrow. So let me say good morning, good afternoon, good evening, traders, and welcome to Short-Term Trading Live with Oscar Carboni. Thank you for your patience. Remember, never trade without stops. These markets are extremely volatile. Do yourselves a favor. If you're ever going to trade anything, stocks, commodities, ETFs, cryptocurrencies, put your stops in first, okay? Now, let's take a look. So I wrote some notes, and I painstakingly went over many charts. I mean, dozens and dozens of charts leading up to this webinar. And those charts brought me to a specific place. And I'm going to go over each of those charts with you and hope to take you to that very same place with me. That place basically is an indicator of what we should do next after this election tomorrow. So welcome to an election electrified driven market, because that's what we have right now. Does not matter technical analysis, a trading system. This is all about the election today and tomorrow. Much of the election, or much of the action that we will see this week, is completely election driven even after the election. Let's see what analysis is current, what we can make use of following the election this week. I won't bore you with selling you a system or trying to offer you a system. I'm just going to show you, hopefully, some really good tricks or tips that you should use moving forward this week, because it will be volatile. Currently, we have certain technical setups, which mostly have been pointing towards the downside in U.S. indices like E-mini, S&P, NASDAQ, Russell, Dow Jones. The bigger picture, as you can see, is they've been pointing lower. The rallies have been sold into, and we end up back lower. So the big picture has been that for the last few months. In fact, since January 4th this year, the landscape has pointed us lower technically. The recent data that we have mined through suggests, this is, by the way, data about elections and markets. This is not Republican or Democratic. They're, if you will, they're politicians, we're traders, so let's not go there. It's just about market data, okay? The recent data we have to mine through suggests Republicans, when Republicans have power, big money, 401k funds, BlackRock type fund managers, they tend to plan for the upside and trade for the upside, using the data that I was able to mine through. The same data suggests that if Democrats gain or retain power, the funds tend to plan for the downside. So now that we know that, we need to go to the charts and see if it goes up, what should we watch out for? And if it goes down, what should we watch out for after the election? after today's session with me, if, and now there's three ifs there, if somehow the current technical landscape changes after this election, and tomorrow the market looks different and it starts looking bullish, we will have a pretty strong handle technically on what to look for and what to expect moving forward. If the landscape stays the same, which is probably more likely, then we will know all the technical areas to sell short or react at. So let's let the market tell us what to do, and we will react accordingly. So I am going to bring you right now to a weekly chart. Actually, let's not even go there yet. Let's go here first. We'll do that a little bit later. Let me take you, because I've worked on so many charts, I want to show you a bunch of them. Let's take you to the beginning of this year. Right up here, the Russell 2000, we had a massive head and shoulders, right? You can see the left shoulder, head, right shoulder, which led into a bear flag. Then somehow a small bear flag within a bear flag was formed, and we gave out a projection, 1698. The market carried through that projection, basically right down to 1698, if you will. This was the low right here, 1698. And then it rallied out, came back down, put in first leg of a double bottom, rallied up, back down, second leg of a double bottom, maybe a triple bottom, depends on how you want to look at that, rallied back up. So we see a picture of mostly down. Inside this big red channel is mostly down, with head and shoulders, which are bearish, and flags, which are bear flags at the moment, which are bearish. And then there's this. We keep running into the 200 bar moving average, that green average right there, and stalling at the red line as well. Boom. All right, so we ran up to the average again recently, and we stalled again. So what do we have to look at now? If the election comes out, whatever the market deems bullish, whoever wins, if it's deemed bullish for the market, likely that would be Republicans, but let's keep that out of this. We should go through the 200 bar moving average, through the resistance, and then you can start using the 200 bar moving average as a buying tool. If the election goes in the way of bullish market. If things stay the same, we're going to use that exact same average to sell from, because it works, proven all the way back here when it started to go down. So that's one chart I looked at, and I said, okay, I see some analysis there telling us certainly lower, but what would I do if, let's say, the election proves to be bullish? I'd wait to get above the 200 and that red resistance line, and I'd start buying pullbacks to those areas. So something you might want to take some notes during these charts, because each chart might have a little something on there for you to hopefully gauge the markets by. So that was my first chart looking at the Russell, and I said, well, let's just go keep looking at other charts. You pull up the S&P. What works in the S&P for the election? I'll show you right now. What was in vogue was the 200 bar moving average. For a while, it was stopping the market. But the 120 bar moving average seems to be way more programmed into Wall Street's algorithms. So here's what we need to watch out for. What you have right now in the E-mini S&P, same thing, basically, as any other market that's a U.S. indice. We have been going down lately, like the Russell. So you're inside of this red channel moving down. Makes sense. It stops cold at this 120 bar moving average. This is absolutely written into temporarily for now. Everything changes quickly and morphs. What Wall Street's using lately is the 120 bar moving average programmed into algorithms. You can tell because the market either holds it perfectly, or when it breaks it, it starts a new trend and starts working its way down. All right, so it breaks it, gets back up, can't get above, gets back up, can't get above. Same thing here. And then we get below the 200 bar and down we start to go. All right, so let's go to now. Now we are bouncing in between the top and bottom of a big bear flag. At the top of that bear flag is your 120 bar moving average. We've already hit it 2 days ago, 3 days ago, and have dropped. So what does this tell us? This tells us if you are going to trade in E-mini S&P after the selection, these are the things that you should be looking out for. A, you've got to get above the bear flag, this blue bear flag. Get above that. Beautiful. B, you've got to get above that 120 bar moving average. Then you've got to get above the 200 bar moving average, and then above the resistance. All of this has to be done first. Needs to get above all of that to become bullish in any way, shape, or form in the E-mini S&P. So these are the things in E-mini that you should watch out for. The 120 is your trigger for now. If it hits that and drops, that's your trigger. You keep selling there. If you can get above that, the 200 is your trigger. Once we can somehow get above 200 in that red resistance line, bingo, 4,800 S&P, here we go. Not calling for that at the moment. We've got an election coming. I promise you that election is going to mean so much to these markets. Now, again, the studying I've done tells me that if Republicans win, we are probably going to go up dramatically. If Democrats win, the analysis that we're looking at now will just follow in suit, and you can continue to use it for the next few months. It's important to see what I'm using because it's working really well. I mean, it's clearly in these pictures, you can tell well it's working, so that you can take advantage of this as well. So remember, S&P, lots of hurdles. Bear flag, 120-bar mover, 200-bar mover, and red resistance line. You get above that, and I'm sure Wall Street will start to get happy. So, of course, I've looked at many more charts than just those two. NASDAQ comes up. If you are trading the NASDAQ this week and you've got the guts to get ahead of that election, the 150-bar moving average was in vogue the last time I did a MetaStock webinar, and that's what we used on this very chart. In fact, every one of these charts are just continued from my last webinar. I like to use the same charts to show A, our projections, did they work? And B, what's most active right now? What am I using? What you could be using. So the 150-bar moving average, which is the blue average, was very, very strong for this market. As you can see, it held it here. But then when it broke, we started a new trend, which then started to cap us off at that average every time we get to it. It's capped off again here. And then we got, of course, down to the 50, and it took control. So we are not using the 150 at the moment. Now the 50-bar moving average is in vogue. So we go there. We look at the 50, which is in the driver's seat. This will be our trigger in the NASDAQ short-term trading now. We're going to do both short-term and a little bit longer-term trading in this little class or lesson, if you will. So the 150-bar moving average was in vogue, and Wall Street was teeing off of it. Now you've got to look at the 50-bar moving average, which will be coming in right up here after the election tomorrow, and look where it's riding along this resistance line, which is right now basically what's keeping the market from moving higher technically. So you've got resistance there. It's just the geometry that the market's working in, to be honest. Support and resistance is nothing more than market geometry. So the geometry is pointing lower, and it's riding along with that average. So if you're going to trade NASDAQ short-term day trading, your 50-bar moving average will be your trigger, which comes in right at the resistance. So it's a smart spot to trigger if, of course, the news is bearish. If the news is bullish, you will get above that 50. 150 is then your test. You get above that, and there's only one last hurdle, our major resistance. You get above that line, and away you go. So I'm showing you what can happen on either side. If we wanted to discuss what I thought the election would come out as, the charts are pointing lower. I would say that about them. That's about all I know. The election could change all of that, but the charts are sort of pointing towards the election going lower. But we're not done with this segment, are we? Maybe things will change. So again, NASDAQ, your 150, not in vogue anymore. The 50 is 50-bar simple moving average. Keep your eyes peeled on that, and the red resistance line, which comes in somewhere near, if we want to look at a price, 22.90-ish. Let's move along. We have more charts to get through, and I don't know if I have enough time to get to all of them. So NASDAQ, another look. Short-term trading, just like the Russell. NASDAQ started off January this year with a massive head and shoulders, which told us the top was in. Of course, I told all of you that in many YouTube videos since then. It had broken down, tried to rally back up, and this is what I call a failed Oscarism known as a head test. You won't find this in any books or anything, but it's my brand, and I've shown it to you in many videos. When you have a head and shoulders, after you drop out of the right shoulder, as we did here, many times you get something called the head test. When that head test fails, the absolute signal that that was a head and shoulders is then confirmed. The head test failed to go higher than the head. It stopped cold at the 200-bar moving average. Interesting place to stop. and down we went. Since then, the 50 ball moving average has taken control, as we spoke about in the NASDAQ. But I wanted to show you the NASDAQ is very much like the Russell 2000. They started with a big head and shoulders, then a bear flag, and boom, and the 50 ball moving average takes over. So what would we do in the NASDAQ? As we spoke when we first looked at the NASDAQ chart, that 50 ball moving average and that resistance line that you see coming in that circle here is absolutely going to give you money if you sell it there, if the election results are bearish. Election results bullish, of course, you get above that and maybe all the way up to the 200 ball moving average. So, of course, if you're a betting type of person, you'd have to bet on any of this happening. Me, I prefer to let the election happen and then decide what to do afterwards. Let's continue looking at charts. So next one on here is just one more quick look, if I remember. Oh, let's go to the transportation average. Oh, my goodness. So the transportation average has been wonderful for signals. After capitulation day, the market has topped, and the 90 bar moving average has been the darling of Wall Street this entire year. For the transportation average, the .DJT, the 90 bar simple moving average has worked the entire year. That will be your trigger. Keep your eyes on that. Above it, it gets bullish. Below it, it remains bearish. Of course, if you get above the 90 bar moving average, you can go up a few thousand points, but then you've got the big red resistance line to hurdle above. But I will tell you the 90 has been perfect with signals. Keep an eye on that for your Dow Jones transportation average. Next, the next chart I had planned to, well, the next chart I looked at for myself was back to the Russell again, because there's more on this Russell. We didn't really look at all of it yet. The Russell, of course, we know about the head and shoulders, blah, 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 all that stuff in the background, and that this voodoo actually works because everything else followed the Russell down as we projected it would. The 90 bar moving average absolutely is still valid right here in that Russell, right? The election's tomorrow. What's capping it from above has been the 200 bar moving average since December, or at the beginning of this year, since January this year. The entire year has been capped off with the 200 bar moving average. That is this teal average running down along all the tops. And that's also the high that we hit 3 or 4 days ago. So you are bouncing between the 90 bar moving average, very valid, and the 200. There is one last thing I want you to recognize in the Russell. There's also this major resistance here. See that red line starts at the highs when we put our peak in. Next run up hits it. We just about failed. We failed to hit it here, but stopped at the 200 bar moving average. This basically, you will trade in between these two averages till the election is done. And then I promise you, either the 200 is going to be what you want to be selling, or the 90 is what you're going to want to buy. There is a really smart signal right there for us when the election is over. There are many people who think that the election is an absolute sweep for Republicans, and that would be quite bullish, and everything I'm showing you is going to blow up, and all the charts are going to go much higher. But for now, I'm following what I see, and what I see is we're in downward patterns, downward trends with downward analysis, which could change, of course, with a crazy election. So remember, in the Russell, you've got a lot to get above. The 90 bar holding you right here. The 200 bar above that. Resistance above that. And the whole thing could be a big flag. So let's keep these in mind because the election's tomorrow. This is going to happen right away, kids. Let's see what else we have. This is all going to boil down to one chart in the end, I promise. So next is T-bonds. New target in T-bonds, write this down, 111 to 109. When we were in the 138 area, we gave a target of 121 in bonds. We have hit that target. And many Omniacs know of these targets. If you weren't there for it, we don't make these things up. I could never make things up on video. It goes out to everyone in the world that follows me, and you can't retract. So everyone recognizes we had a target of 121. We are now new target 111, 109 in bonds. If you recall, during the first webinar I did this year for MetaStock, I put this bond chart. In fact, every one of these charts you've seen before. If this is more than your first MetaStock conference webinar with me, that bond chart, I showed you that it was a good moment when we crossed the 100 with the 200, and then it went bad. And once it went bad, so did the market. Now we are in this very steep channel, and that is your analysis on this. You don't need anything else. This channel is your analysis on bonds. It has stayed in this channel since 140, and it's going to stay in this channel straight down to 109. So keep your eyes on that. Nothing goes straight down, as you can see, but bonds basically make bear flags and drop further, and make flags and drop further, and that's what you should expect moving forward in bonds. Not quite tomorrow, of course, but over some time. What else did I have? I know I've got some targets on a few of these charts I came up with while I was doing my analysis. Here's an interesting chart. Look at the dollar index. Now, traders, if you are from any other country on this planet, I apologize for our president. I apologize for our nation. I don't know why we would hold back the oil and put you guys in such severe shock when our dollar is going up so high. The problem is we see inflation very little. We hear about it, right? You go to the supermarket, there's shrinkflation. Some things are a little more expensive. Only at the pump do Americans feel this inflation. Only at the pump. People can hem and haw, but I promise you, compared to anyone in Europe or almost any other country where their currency is going down compared to the U.S., we are in a heyday right now, and I apologize to you for our country not letting the oil out. I would let it out in a moment and knock down this inflation. I can't help you there, but I can help you trade. So the dollar index has been in this insane bull channel since it created a bull flag. But the interesting thing about this dollar is the 70-bar moving average. Look at the way it is just built into the algorithms. It is just there. If it gets there, so is Wall Street. They're waiting for it when it gets there, and they just attack. All right, so we know that's working. We're inside of a fantastic channel, and this is probably a bull flag, this green thing right here. This is most likely a bull flag telling us, because they're still raising interest rates, we will likely still go higher in the dollar. Of course, the election could change everything, but this is what we have today, Monday. Now, the interesting thing again about the US dollar, you Europeans going to appreciate this, the 70-bar moving average, absolutely your trigger. Write that down. When you get to it, you can buy it. If somehow it breaks it, it's a whole new thing starting. That's the US dollar. Barring the pump, I promise you, Americans do not feel the inflation like this next picture. Imagine not having US dollars and having a euro currency, while the price of crude is ridiculously expensive, $93 a barrel today in crude. This is a disaster when you add in the high price of crude and inflation, because your euro currency is stuck at the 70-bar moving average, just like the dollar, but on top of it. And that is your trigger to sell, or if you get above, something new is about to take place. So Europe, if you're trading a euro traders, euro needs to get above the 70-bar moving average and above this red resistance line, and away you will go. However, that is not the pattern. The pattern that we see, as you can clearly see, is you hit that 70-bar moving average, down you go. So use the 70 on euro currency if you don't know what works well there. These are all daily charts, by the way. But again, your currency moving down like this with inflation and high crude, my apologies to you, Europe. I wish I could convince our president to let out some oil and drop this problem, but it is what it is, kids. Let's move forward. Let's get into some crypto for a moment. You know, I have mentioned and literally have had conversations with, found myself on the side of me standing on one side and 72 other crypto traders standing on the other. When I tell them that Bitcoin and Ethereum are absolutely tied to Wall Street, and Wall Street's algorithms are being used on Bitcoin and Ethereum, because Bitcoin and Ethereum both have futures markets, which are regulated. And I promise you, they have figured out algorithms which work with them. And how do I know? Well, Bitcoin starts out the year with a big head and shoulders, like NASDAQ and Russell, drops into a bear flag, like NASDAQ and Russell, and then proceeds to continue to dump after breaking the 200 bar moving average, like NASDAQ and Russell. Okay? They are connected. The Bitcoin, though, looks worse than Ethereum. Look at Bitcoin stuck in this massive flag, bear flag, or just a flat, if you will, massive plateau, and it is just stuck there. It did get above this red resistance line, so there's a teeny bit of light at the end of the tunnel, but it's just stuck in this big bear flag, this blue bear flag in a flat. And there is nothing good to say about Bitcoin at the moment. But Ethereum is performing better than Bitcoin. Let me show you that. Now, Bitcoin will have its move. 3 years, 7 months from now, Bitcoin will be at 85,000, I promise you. But we've got to wait for that. Look at Ethereum. Now, Ethereum, there's a little light at the end of the Ethereum tunnel. Yes, it had the big head and shoulders and into the bear flag and the big breakdown, like everything else on Wall Street, which has been tied to hedge funds with algorithms. They all look kind of the same, right? These charts are all the same, basically. They're all going in the same direction, except for the dollar index. But Ethereum has broken above this 18-bar moving average, and that seems to be when it wants to go up, like here. Got above the average, or at least I should say from here, gets above the average, and boom, nice rally. But then it gets below, and it tries, and it stays below. Well, now we're above, and we got above the red resistance line. And if you will, I know this isn't, you won't find this in any books or anything, but there's an Oscarism known as an F flag sitting right here. Look, let me point that to you. And that usually can stay bullish for some time. So now you've got what I call an F flag, which is slightly bullish for sure, in Ethereum, above the 18-bar moving average, and above resistance. So a little light at the end of the tunnel for Ethereum. Go Ethereum. I hope it can go up on its own. I own a bunch of it. You better go up at some point, sir. Once again, Ethereum and Bitcoin, my 5-year target has 3 years, 6 months to go, 85,000 Bitcoin. I'm not worried whether we'll get there or not. Analysis works really well. So what's next? Traders, I put NVIDIA in front of you at the last MetaStock Traders Conference, and I showed you I had something that I like to call my knock formation, if you will. And what that usually means is you cannot knock on a door in this business, commodities trading business, futures or stocks. You can, crypto as well. You cannot knock on a door this many times without an opening. So the NVDA comes down and hits this door, if you will, and knocks on it. Goes right up to the 90-bar moving average and hits the door. Goes back up to where? 90-bar moving average. Knocks on the door. Knocks again. Knocks a fourth time. Where's it go? 90-bar moving average. Drops down from that, knocks a fifth time, and when it knocked the fifth time is when I put this in front of you at the last MetaStock Traders Conference, and I told you there's just no shot it's going to hold. That's it. Now it comes down. And there was a bear flag sitting there, right? You can see the bear flag as well. So simple analysis told us this is going to break. Knock, knock, knock. It does break, and down we go. Well, that movement down creates this red channel that we're in. Big, bearish red channel. The 90-bar moving average is your trigger on NVIDIA. It works like magic. Write it down, use it, sell that 90-bar moving average when you see it. And of course, if somehow we could get above it and stay above for like 3 or 4 days, it becomes your trigger to buy off of. That is your trigger for NVIDIA. So if you are an NVIDIA trader, that would be the algorithm, if you will, because they get programmed into Wall Street's algorithms. That would be the average that you want to key off of until things change. So one of my sayings is you cannot knock on a door, a stock door, this many times without it opening, and knock, 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 knock. It opened. We've got some other knock, knock charts going on in our spectrum of charts. I don't know if I've got any drawn up for you right here, but I think gold is one of them. So let's see what we have next. We looked at that. Let's go look at Zoom. Oh, another thing. Write this down, kids. In the last 3 webinars, this has been working for a long time now. In the last 3 webinars, the 55 bar moving average has proven to us that it is magic on Zoom. Magic. So I gave out a projection when we were at 126.44, and I said we would drop to 99.30. Well, you know what? We dropped all the way to 99.30. It was hit. Boom. Previous projection hit. New projection out. We were at 99.30 in my last MetaStock presentation. You can check this if you want to go back and look at the tapes. And I said we would drop to 49. Well, now we're at 77, and the target of 49 remains valid. So Zoom, ZM, down to 49 eventually. Key off the 55 bar moving average. That is your key if you are a stock trader who likes to mess with Zoom. What else did I prepare for you cats? Now check this out. This is it. This chart says it all. Simplify what's going to happen, how you should trade, what the election may mean. Dow Jones Industrial Average, this is the market. It's as easy to read as the day is long because what's happening here is before your eyes. When that election's over, if you fail at the 200 bar moving average, you're done. If we get above the 200 bar moving average, it's something completely new. This is it. This is the one that says it all for short-term trading. For short-term trading, just watch this tomorrow. If we end up above this, away you will go. If you stop cold in this area, you've got your sell ticket. That is it. This chart says it all. This election has set the stage. This is set. The Dow is going to speak volumes. That is a key chart for short-term trading. Keep your eyes on that one. Now I'm going to start to talk about weekly charts. Let's go out a little further because after all the daily charts, I looked at all the weekly charts, and everything that I've looked at brought me to one chart, sort of like the end of these daily charts brought me to this one, the Dow. The Dow says it all. So all that work we did sort of brought me to the Dow. The Dow says simplified. Look at that right there. That's about as easy on the eye as you'd ever want it to be. But we're going to go out to the weekly, and we're going to start to look at those because there's a big difference. And let's go do that. Let's start here. Now we're going to take our eye off the short term, in and out, jumping in and out of trades. Monday, trade on Monday, trade again on Tuesday, trade again on Wednesday. Let's now pull this thing back. Let's start to look at the forest. We want to see the whole thing, right? I want to look at the whole forest now. NASDAQ weekly chart, 200 bar moving average. Wall Street's darling, we all know this. On the weekly. Look, 1, 2, 3, 4, 5 weeks have been spent around the 200 bar moving average. 4 of them below. I don't see the chart below the 200 bar moving average here. Or here, almost anywhere, not below. Okay, your NASDAQ. This is going to be a big picture. It's something I've been following ever since the NASDAQ started trading, to be honest. I've got charts that go all the way back, and I always keep my eye on the NASDAQ. Of course, who wouldn't? And I like to always have long-term charts, which some of the charts I can pull up or literally have been drawn on for about as long as I've had the internet and trading programs that would allow me to put charts on computer. Used to be on paper in the old days. Thank God they're on computer now. So I literally have charts that go back forever. So I keep my eyes on so much of this so that if I see something different or if I see a repetitive pattern, brings me back and it makes me do some longer-term analysis to keep the short-term analysis in focus, and that's what we're doing now. NASDAQ, longer term, each one of these lines here, each one of these bars represents full week of trading. Full 5 days of trading is each bar, red or green. The other charts we were looking at, each one of those bars represented only 1 day, so it's fast term. Much longer term here. Very slow movement in your indicators, in your averages, and big movement from Wall Street, when you hit these averages on the weekly. So that's your NASDAQ, and it looks to stay above that 200 pretty cleanly, except for now it's having some trouble with it. Look at the Dow Jones Industrial Average on the weekly. Same thing as NASDAQ, weekly bar. Each one of these lines here, or weeks, represents 1 week. So each one of these bars represents 1 week. You got under the average a little bit and took off, got to the top of the channel. Very active, boom, boom, jumped around. During COVID, you smashed through the 200-bar moving average like it wasn't there. Here we tested it but held. Here we tested it and held. 2008, it smashed through. But you do get through it, right? You get through that average sometimes. And when you get through the average, believe me, it doesn't look like this is large, but we are talking about a price of $23,719 at the average. It got down to $18,240. Very big break under that average. So it's key if you break the 200-bar moving average on a weekly chart. So the Dow does break it. You know, luckily it doesn't stand too long, but it certainly does break it. We've held it recently, and we rallied to the top of the channel, and it's election day. The top of that channel is either the top, and down you go to the bottom of the channel when the election comes out, or a breakout, right? It's an election, so I can't give you what it will be. I wish I could tell you what the election results would be. And I can tell you what to buy or sell. That's why I have to give you areas to pay attention to. So you need to pay attention. You can draw these yourself on your own computers. You're just connecting the highs. I cut through that high there because these two connected was smoother, and it connected to the third high, so that one breaks through. This is your trigger area in your Dow. And, of course, this is your trigger area in the Dow. So if you just draw the same channels I'm drawing, you can kind of see what you should be looking for. The price that we're at up here, by the way, if you need a price, is somewhere around 32,967, 965. But you're going to have a lot of trouble there. This is either explosion all the way up, or that will top you out. The election is going to tell you that. Then you can react. There's more weekly charts, though. Transportation average. Now, another one. During COVID, big smash down. Huge breakdown, actually, during COVID. Tested it here recently. Rallied back up towards the top of the channel. Kind of looks like a bear flag to me. Wouldn't you want to consider this thing a bear flag? Right? If I looked at that, I'd go, well, nothing's perfect, especially with analysis, because it's a fine art, not a science. But I would think that this is some form of a bear flag. So it's, you got a bear flag forming at the top, possibly, of a channel. There's a lot of analysis going on here. You're holding the 200. There's an election taking place. A lot going on here, kids. So, best thing to do is use the 200 as your trigger, which is what I will do, and the top of the channel. The election will tell you which way to go. You just got to be brave enough to go after the election results. So transportation average broke down in 2016 twice. Broke through it in 2011. Broke through it in 2009. Broke through in 2008. Let's think about that. The Dow Jones Transportation Average broke the 200 in 2008. Again, it breaks it in 2009. It breaks the 200-bar moving average again in 2011. It breaks it twice during 2016. It breaks it during COVID. And it's challenging it now when there's an election tomorrow. So that tells me that looking at Dow, S&P on the weekly, you get some breaks through the 200-bar moving average. You got to be careful when you get down there. But let's go back and look at one more chart. Let's go look. Well, two more, actually. Let's look at the E-mini S&P. I don't think we've done that yet. So E-mini S&P, a little more stable. Right now, we're testing the 200. Broke it during COVID, but held it in 2016. Did break it in 2011 and 2009. So more breaks there. Now we're going back to the NASDAQ. This, my friends, is what all of those charts brought me to. Use this after the election for a sense of direction. This is absolute. This is what's happening. This is big. Now let's go back and look at this NASDAQ again. Now that you've seen all the other ones that often spend time below the 200-ball moving average, so you got to be careful when they signal, not the NASDAQ. This is a lot of time below the average because here you didn't even touch it. During COVID, it held, kids. During COVID, the 200-ball moving average did not get broken on your NASDAQ weekly. That is huge. So what could possibly break it? Nothing breaks the 200-ball moving average on the NASDAQ. Nothing except for 2008. That was it. And it was brief. That was it. Nothing else breaks the 200-ball moving average on the NASDAQ. Nothing. Except for where we are now. That's why I am telling you that this is big. This is your indicator. This is it. You don't need anything else. The NASDAQ weekly is going to tell us for the next few weeks if we're buyers or sellers. That is so absolute. That is perfect analysis. If you're a 200-ball moving average user, there's no better chart than the NASDAQ on the weekly to let you know if we should be buying or selling. That is what I went through in the last few days. Well, I'm always going through these charts. That's what I came up with, and I thought I wanted to share that with you. Now, there's a lot going on, and of course, we do a lot of day trading in between. So if you'd like to hang out with me, you can just find me very easily. Just go here to livewithoscar.com. Membership is absolutely free. Not even a credit card is required. It's livewithoscar.com. Do the login or register. If you, of course, you're not a member, you would register. You hit register. It's going to bring you to a page. It takes barely no information at all. Receive an email, send it back, and you are here at the OMNI page. Once you've come to the OMNI page, you can just join me in my live trading room. I'm there all the time. All of this is free to you, and then we can continue talking about these charts. Chat live with Oscar, and that's it. You're in there. There's OMNI BOOTCAMP. If you want to know a little more about me, you can fill out a comprehensive application, and I can call you on the phone, and we can have a consultation. So the consultation site is here if you'd like to schedule a consultation with me. Barring that, I would be more than happy to answer questions for all of you. I don't have a program I'm looking to sell you, and I do have something called the OMNI, Oscar's Market Navigational Indicator, which is a 4-day seminar held live in Las Vegas. That's not going to happen here during our little 1-hour webinar, and that only literally takes place in person for 4 people at a time. If you're interested in working with me, I promise you, it will. If you learn analysis the way I trade, it will change your life. You can go to OMNI Bootcamp and fill out your comprehensive application. It's right there. It's simple. Of course, you scroll down, you click on any of these links, they'll all get you to an application. And barring that, I just hang out and trade and live my life doing analysis and let all the Omniacs around the world that want to hang out with me kind of look over my shoulder and trade with me. That's what I do, and that's what I'm basically offering here. I hope what I showed you, some of these techniques you'll be able to use moving forward, and I'd be more than happy to answer some of your questions if there's questions building up. I don't know. You let me know that, Jeff, because my internet, because I'm using the phone, I don't really want to open up YouTube and see what's going on there.
Yeah, no problem. Let's see. Actually, we have a lot of questions from, here's one from Michael and William. They want to know, how do you choose the periods for the moving averages you're using?
Well, you know what? The simplest thing to start off with is the 50 and the 200-ball moving average. And the only reason why I say that is because I grew up on Wall Street since I'm 18 years old. That's what they like. Who cares why? You know what I mean? Trying to ask why or trying to change those, it's like reinventing the wheel. Being that Wall Street loves it, sure, put it on your car and drive really fast. However, those averages will morph and change from time to time. The 50 and the 200 are very abstract, and they're larger type averages. What you'll notice is that Wall Street will get all the way down to like 14, 15 ball moving averages. The smallest thing you've ever seen that wiggle like crazy. The best thing to do to find out which average works is literally pull up a chart and find an average that stays out of the chart's way. In other words, you wouldn't want to use something like this as an average. Let's go change parameters. You wouldn't want to use this on something like this because it gets too involved. And we're looking at a weekly. If I bring you to a daily, you'll understand why I just said that. So let's go to a daily. You don't want to use short-term averages on daily charts because they get in the market too often and you just don't know what signals they're giving you, right? So instead, I'll start moving these averages around until I find something that looks suitable. And when I start to notice that it's out of the market's way and it's catching tops and bottoms without being broken, even this is spending too much time in the market for me. So I prefer to find averages. If I could draw one, I would say you want averages that sort of just barely touch the market and stay away. Those are the ones that you want to look for. And it's very simple to change averages and experiment, right? So you change them and you say, well, the 32 isn't working. Is it the 100? You want to stick with things like this, by the way. Wall Street, for whatever reason, and who cares why, thinks 100, 200, and 50 ball moving averages are golden. And then sometimes you'll see them get really small when markets get extremely volatile, and they'll do like a 21 ball moving average. Less often used, more of these are being used. But when the markets get extremely volatile, you can go down to smaller averages. But what you need to do is make sure that the average stays out of the market's way. And in fact, if we look at this, if we move this out even further, let's call this the 150. You'll see what I mean by that. Just stay out of the, there you go. Now you see how that average is just out of the way, right? You see how it's just out of the way, but when you get to it, something meaningful will happen. That is an average I'd consider using. Anything else that, as I showed you earlier with that shorter term average, if it's jumping through the market, it's kind of useless. It's a guessing game. But if you can find an average that's doing what this one is, let me just move some of this out of our way. If you can find an average doing this, you found a good average, you lock it in, and you start keying off that average when you get to it. I hope that helps. Anything else for us, Jeff?
Yes, but I need to find how to unmute my microphone first. Amit wants to know, how do you know what timeframes to use in a chart?
So for me, because I've been in this business long enough to know better, I use daily, weekly, and that's about it. I stay away from any of the smaller time frames that give too many false signals, in my opinion. Well, let me say it this way: if you're going to use a 10-minute chart, you should be in a 10-minute trade, not a daily trade based on a 10-minute setup. You want to use a 10-minute chart, get in for 10 minutes, and then get out because the trade didn't work. You want to be in for a daily trade, use a daily chart. You'll do much better.
All right. This one, I think we need to read a legal disclaimer before I ask you. We don't recommend specific trades here. But Bala wants to know if you think a long straddle would be a good idea on SPY. I think that might be too much into the thing. Yeah.
Are you talking about a strangle or a straddle? So if you're going to do a straddle, great. If you're going to do a strangle by the wings, turn it into a butterfly, so that you're not totally exposed. And I'm sure if he understands straddles or strangles, he understands what that means as well. So if you're going to be long the two options, great. Straddle. If you're going to be a strangle where you short those two options, spend a little money and buy protection above and below so you don't blow out.
Okay. Again, not a recommendation. Just for education.
Oh, if that's what you want to do, I'll show you how to do it without losing your pins.
All right. Rich says, great insight. Thanks, Oscar. Great insight as always. So, and that's the end of the questions. So,
okay.
I was going to talk a little bit about that course we did about a year ago.
Okay.
But I can. I'll do that after we let you go. I want to say thank you for coming in. I'm glad we got you some power.
I can't believe I made it through with the T-Mobile hotspot. Hey, no commercial, but go T-Mobile. I wasn't expecting that to last this long.
All right. Very good. Thank you very much, Oscar. I really appreciate your coming in.
Okay, everyone, I hope that helps. I hope some of these techniques I've shown you, you've written them down and we'll use them because I promise you they're quite powerful. Now, The OMNI that I actually teach, Oscar's Market Navigational Indicator, is much more complicated than this to look at, but just as simple to use. So if you ever do want to learn the OMNI, you come down to livewithoscar.com and get in touch with me, and I'll discuss that with you. Jeff, MetaStock, everybody, thank you so much. I appreciate it.
Thank you, Oscar.